Scroll through property reels for 5 minutes. Suddenly, your feed is full of luxury 3 BHK, premium lifestyle living, ready to move in prime location. Everything looks perfect on screen, but then you visit the flat in real life. Kitchen tiles from the past, bathroom fittings straight out of affordable housing segment, and the balcony opens into somebody else's balcony. The broker still smiles and says, "Sir, this is a premium property." You go home, open your salary slip, do the math, and one thought quietly forms. Is this even for people like me? Here's what nobody tells you. Thousands of Indian families ask the same question, sign anyway, and realize 6 months later there's nothing left. No savings, no investments, and no breathing room. They didn't buy a home, they bought a financial trap. That's what this video is about, the real math before you sign. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is FinNiki, where I simplify money the same way I practice it. And today, we are going to do something real estate agents and home loan DSAs absolutely hate. We are going to calculate who can actually legitimately afford a 2 crore house in 2026 without turning their entire financial life into a 30-year slow burn. Because there's a massive difference between getting a loan sanction and actually sleeping at night after you sign those papers. Let's get into it. Let's start with the number 2 crore. Say it out loud, feels like a lot, right? It should. But now here's what 2 crore actually buys you in Mumbai, Bangalore, Hyderabad, or even Pune in 2026. Not a sea-facing apartment, not a rooftop pool, not a gym with actual equipments. In Bangalore, maybe a 1600 square foot 3 BHK on outskirts, and in Mumbai, maybe a 900 square feet 2 BHK. That's it. That's the 2 crore dream. And here's where it gets truly uncomfortable. The median household income for salaried urban families in India is somewhere around 6 to 8 lakhs per year. We are asking families earning 10 lakhs a year to buy homes that cost 20 times their annual income. If that ratio sounds insane, it actually is. And yet, the home loan agent says you're approved, your relative says your properties always goes up, some guy on Instagram is always flipping flats in Whitefield with zero down payment. So everyone around you is nodding and smiling and telling you it's completely doable. Here's the truth. They're all lying to you about what actually affordable means. Not maliciously, but they are lying. And that lie has a price, and you are the one who's going to pay it. Let's start with the down payment, because this is where most homeownership plans quietly collapse even before the EMI even starts. Standard expectation: 20% of the property price. On a 2 crore flat, that's 40 lakhs cash upfront. The average urban Indian family has maybe 2 to 5 lakhs in liquid savings at any given time. So you're not just a little short, you're quite short before you have even touched a single loan document. But fine, let's say you decide to save it. You're earning maybe say 20 lakhs a year, already in the top 5% of Indian earners. You are disciplined, you save 15% of your gross income, that's 3 lakhs a year. At that rate, it takes 12 years to save the down payment. By then, the flat cost may actually go up to even 4 crores. So most people don't wait. They scrape together maybe 10%, about 20 lakhs from savings, a broken FD, family help, maybe even personal loan nobody talks about. And that's when the bank rewards their efforts with a slightly worse deal. Higher effective interest rate, lower loan to value ratio. Mandatory credit life insurance that protects the bank, not you. In America, they call it the PMI, that is private mortgage insurance. In India, it shows up in subtler ways. A processing fees that makes your eye water, a rate 25 to say 50 basis points higher, and one clear message. Because you weren't rich enough to pay more upfront, you will pay more every single month. This is the poverty tax built into the home loan system. Now let's get to the real numbers. 20 lakh down payment, 1.8 crore loan. At current rates of 7.5 to 8.5%, your EMI on a 20-year loan is roughly 1.45 lakhs to 1.55 lakhs per month. And that's just principal and interest, not a single rupee of what it actually costs to live in that house. Now let's add everything the bank conveniently leaves out of the brochure. Property tax. Municipal property tax on a 2 crore apartment runs to say around 15,000 to 30,000 a year. That's roughly 2,000 to 2,500 rupees a month. Maintenance charges. Most housing societies in this price range charge around 5,000 to 12,000 a month. for security, common area electricity, and that lift that's always broken. Home insurance, still tragically underutilized in India. But if you're being financially responsible, budget 1,500 to say 3,000 a month for a comprehensive policy. Repairs and upkeep. Here's a rule most people have never heard. Budget at least 1% of your home value per year for maintenance. On a 2 crore property, that's 2 lakhs a year, which is about 16,000 a month. Geysers fail, pipes burst, walls need painting, waterproofing doesn't ask for permission. Add it all up, you're talking about a monthly EMI of say about 1,50,000, society maintenance charges of around 8,000, property tax say 2,000, home insurance say 2,000, repairs and upkeep, which is a 1% rule, which is 16,000. The total monthly housing cost is now 1.9 lakhs. 1.9 lakhs per month, every month for next 20 years. And that assumes nothing goes wrong. No special society levy, no builder OC issues that actually becomes your problem, no job loss, no medical emergency. Just a perfect normal life with 1.9 lakhs going out of the door before you've even bought a single bag of groceries. And if you're finding this useful so far, just hit the like button and subscribe. It really helps me keep making content like this. Now, most financial advisors say don't spend more than 30 to 35% of your gross monthly income on housing. The RBI and most banks will approve you up to 50% FOIR, that is fixed obligation to income ratio, meaning the total EMI should not cross more than half your gross income. But let's not follow the rule blindly. Let's reverse engineer this. Total housing cost 1.9 lakhs a month. If that's 30% of your income, you need to earn 6.3 lakhs per month. That's 75 lakhs per year. If you use more lenient 40% rule, you still need 4.7 lakhs a month. That's 57 lakhs annually. Now, here's the reality check that nobody in the property market wants you to know. Only 1% of Indian household actually earn 50 lakh or more per year. Even if you stretch to 30 lakhs, that's still less than 5% of the country, which means 95% of Indian households cannot comfortably afford a 2 crore home loan under any reasonable financial framework. So then, who's actually buying it? Some are dual income IT couples in Bangalore or Hyderabad, both earning say 20 to 25 lakhs package. Some have NRI relatives who wired the down payment, some sold inherited property to upgrade, and some, a significant number, are stretching so dangerously thin that one job loss or one medical emergency would collapse everything. Let me show you exactly what that looks like. Meet the Sharmas. Combined income 2.5 lakhs per month, about 30 lakhs a year. One is in a mid-level IT role, the other is in a private job sector. Solid upper middle class by any standard. On paper, they look exactly like the family that should be able to buy a 2 crore home. But here's what actually happens when they sit down and do the math. From 30 lakhs gross income, subtract income tax of say about 45 to 50,000 a month. PF contribution say 15 to 20,000, health insurance and other deductions, their actual take home drops to roughly 1.8 to 1.9 lakhs per month. That housing cost is actually 1.9 lakhs per month. You'll remember this. That's the entire take home gone before even a single grocery run, before fuel, before paying any bill. Now in practice, most families don't go this extreme. Let's be realistic. Let's say the Sharmas bring their housing cost down to say 1.3 lakhs a month through maybe slightly smaller loan or family support on the down payment. Even then, they're left with 55 to 60,000 a month for everything else. Groceries, transport, utilities, parent support, medical expenses, a car EMI, some savings occasionally, just occasionally something they actually enjoy. For a household earning 30 lakhs a year, 55,000 a month in discretionary income is not a breathing room. That's nearly 50% or more of take home going towards housing alone. Before parents' medical expenses, before annual travel, before children's tuition, before any emergency whatsoever. And the Sharmas are not being reckless. No Tesla, no Bali holiday. They're simply trying to live in a flat the market told them was completely normal. Which raises the real question. If even financially responsible people can't make this math work, what exactly is going on here? Think about everyone in the transaction for a moment. The builder, the bank, the broker, even your CA. The builder prices at 2 crore because that's what the last flat in the building was sold for. He is not thinking about your salary slip. The bank sanctions the loan because your FOIR technically fits. Getting you in is their business. What happens after that is not their problem, it's your problem. The broker earns 1 to 2% commission on the sale price. The more expensive the flat, the bigger his check. he has exactly zero incentive to tell you to buy smaller. And your CA, he might just say, buy property and save tax, because Section 24 looks great on paper until you realize you're spending 19 lakhs a year on EMIs to actually save 2 lakhs in tax. Remember, every single person in that room profits when you sign. Not one of them profits if you walk away. The system isn't designed to ask whether you can live comfortably in that home. It's designed entirely to get you into it. And once you sign, you are locked in. You can't wake up 6 months later and walk away. That means it's destroying your CIBIL score, losing your down payment, and entering a legal process that drains your time, money, and sanity for years. So what do most people do? They don't walk away. They stay, they grind at jobs they resent, watch their savings drain month after month, and slowly convince themselves this is what building for the future is supposed to feel like. In reality, it isn't. For 85 to 90% of Indian households, a 2 crore home is not affordable, not sustainable, not without taking on a level of financial risk that would have been considered reckless just a generation ago. And this isn't about personal failure. It isn't about not working hard enough also. The math has changed, full stop. Since 2005, home prices in Indian metros have risen by 200 to 300%. Median urban salaries in the same period have gone up only by 80 to 100%. The gap between those two numbers is where the entire problem lives. See, the math does not work, it cannot work. But yet, we keep pretending that it does. We keep telling people renting is throwing money away. But nobody mentions that an EMI you can't manage is also throwing money away, just with worse consequences and far more paperwork. We keep saying property always goes up. Maybe it does, but first you have to survive the mortgage. Because owning that asset means you can't invest, you can't save, you can't handle an emergency, and you can't sleep at night. What is that asset actually doing for you? Most people hear all of this and think they have two options: stretch and buy or give up entirely. That's not true. There's a third path as well, and this is the one that actually works. Here's the part nobody gets to because most videos stop at the problem. You have a real option, and none of them require you to give up on owning a home. They just require you to stop playing a game that's rigged against you. Option 1, keep renting, investing the difference. A well-located 3 BHK in Bangalore or Hyderabad rents for about say 45,000 to 75,000 a month. Your all-in ownership cost on that same flat would be around 1.5 to 1.9 lakhs we discussed. The difference? Over 1 lakh every single month invested in equity mutual funds over 15 to 20 years will likely outperform your property appreciation, and you'll have liquidity. Real liquidity, not the flat that you can't sell without a 6-month process and a broker's commission. Option 2, buy in a more affordable market. Tier 2 cities like Indore, Nasik, Coimbatore, Bhubaneswar offer genuine 3 BHK homes for 80 lakhs or so. Your EMI drops to something manageable, your savings stay intact, your life stays yours, and increasingly remote work means you don't even have to sacrifice your career to do it. Option 3, buy smaller in the same city. A 1 crore 2 BHK in the same city is about 15 lakh down payment, EMI of roughly about 75,000 a month, changes the entire equation. You're in the market, you're building equity, you're not financially suffocating. It won't get you likes on Instagram, but 10 years from now, you'll have savings, investments, and options. That's worth more than the extra bedroom. None of these are compromises, they're just smarter versions of the same goal. Remember the family from the start of this video? The one that found the flat, ran the numbers, told themselves they would make it work, and signed. 6 months later, nothing left. The difference between them and financial peace isn't income, it isn't ambition, it's one question asked honestly before signing. Not what loan am I approved for, but what can I actually afford without dismantling everything else in my financial life? Find the number where you can pay the EMI, handle repairs, save for emergencies, invest for retirement, and still go out for dinner without doing mental math at the restaurant. For most people, that number is nowhere near 2 crores, and that's not failure, that's clarity. The builders will keep calling it an affordable luxury project because that's what is selling. The bank will keep sanctioning the loans that shouldn't exist. The brokers will keep telling you that prices will go after a few months, so hurry up. You don't have to participate in that delusion just because everyone around you is. Sometimes the smartest move is recognizing recognizing when the math doesn't work and choosing not to sign. If you found this useful, share this with someone who needs to hear it before they sign something they'll actually regret. And comment below at what price does a house become unaffordable for you. I read every single comment. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with FinNiki. Thank you for watching, and I'll see you in the next one.